Stavros Tousios for M4Markets. We're going to start the week with WTI and dollar CADs. It's an interesting case with the WTI because we have been trading in this range for a while, between 66, 67 and 74, 75, let's say. We have seen a new low and a new low on the RSI that suggests there is convergence. We started moving up with an impulse move to the upside, which means 5 waves would suggest, of course, a short-term correction and further continuation. However, doesn't necessarily indicate or suggest that we're going to see a breakout. Now, from experience, though, we do need to understand something, right? When we are in a range and we see 5 taps of bottoms and tops, and that is typically when we see breakouts. So there is 2 cases that we can see moving forward in the short to medium term, I would say. If we manage to go up to that top, there's either going to be a breakout or a break down, because eventually if that rejects prices, the chances of that low breaking instead are going to increase. Okay, so the short-term reaction though is expected to be the same, statistically speaking, because this looks like a wedge pattern here. And wedges are correcting and then typically continue into the predominant direction of the trend. Now, the case though is either we're going to get that as a correction and then find that top and then go down, or we might see a breakout initially and then just go towards the 80 through the 77 and then 79, I would say. Of course, we need to ensure that we can recapture the top, which is around 74 at the moment. So sideways, a breakout is expected fairly soon. There is, of course, this scenario that is a little bit less likely for this to be an already corrected move, right? This would be the corrected move, actually. That means that we would actually go straight down. So we're not going to go back close to 74, 75 until we see that low being taken out first. Now, when it comes to dollar against the CAD, it's a bit of a different story because typically they move in inverse. We have broken outside the channel, retested the channel, and slid. Not just slid, was actually slid below that previous low back in November at 132.50 or so. And while we did do that, we came up and retested it. Now, when we see levels like flipping from support to resistance or resistance to support, that suggests, of course, that the predominant trend is still strong. So as long as we remain below 132.50, okay, there is potential for further downside in the short term. What is though screaming here that there is bullish divergence is the RSI. And we've seen repetitive signals, especially now even here, prices are going down and the RSI still remains like in divergence. This is what is interesting. And this suggests that although short term we might see one more leg to the downside, we might be due a correction towards the 144.34 or so soon. If we manage to re-enter the channel, we might put a full-blown reversal low in, and that of course would eventually start moving higher towards 140. But if we fail and we get rejection, then it would indicate much further downsides pain, which would of course extend to a medium, perhaps even longer term. Now, typically, how we want to work out where markets could turn is by using the 100 Fibonacci extension. If we use the last leg and the last correction up, 131, which is a round level as well, is what the 100 Fibonacci extension is. So perhaps a move towards that low, without necessarily mean that we're going to revisit it, could potentially play out, and from there, perhaps even a second signal, with the RSI might be where, the chances for a short-term reversal, at least towards the channel top, is going to appear.